Good afternoon. This is Brad Dennis with BIS Commodities with a market wrap-up of the first week of September 2014. It was a shortened week, which saw lower grain prices at the beginning of the week and then a little bit of risk premium added towards the end. In the corn market, the government said that the good to excellent ratings for corn was up 2% this week, as opposed to a seasonal trend of being down as we get closer to harvest. With the good to excellent rating being at 74%, one of the highest readings ever, we saw corn prices test the lows from last week, break through them, and establish new contract lows. Along with that corn rating, we had numerous analysts out there with their private forecast for yield. A lot of the private forecasters are talking a 171, 172 yield for corn. You have that along with looking at the old crop supplies, looking that we might miss our export numbers on old crop corn, and we might be off a little bit on our ethanol numbers. You add those together, you can put another 100 million probably on the 1.8 million carryout that we have right now. Then you boost up your yield, and we're well over 2 billion for next year's carryout. That had traders spooked, and we saw a sell-off in the corn market. Now in the beans, similar scenario. Good to excellent rating was up another 2% this week. We are also looking at a week where we were a little disappointed in the sales for beans. People are looking at the crop. They know that it's a big crop. They're not going to be aggressive as buyers out there. Next week we do have a group from China that'll come over and probably announce some private sales, but that's as expected, and that happens every year. We're still looking at the beans working through that transition from old crop to new crop, and early yield results coming out of Mississippi and down south are much higher than expected. So we're starting to see that pipeline get filled a little bit, but it's nowhere near done. So both corn and beans, good to excellent ratings are up. You know, private forecasters keep increasing yields. Some are estimating we might have a 4 billion bushel bean crop this year. So that did weigh on prices until today. And today, basically, we saw a little more confirmation on the forecast, and traders are very nervous about the September 11th, 12th, 13th, or next weekend as to frost scares. Remember, to kill off anything, you need 28 degrees for a matter of 2 hours before you kill any crops. And some models do have the temperature getting down to that area. Most do not. But it is something to take some shorts off and to reduce positions, especially with a S&D report out next Thursday as well. So on Friday we came in here and we saw a little bit of frost premium put onto prices. If you look at the whole scenario and the worst case scenario with 3 days of killing frost out there, you're probably looking to 1 to 2% taking off the potential of this crop. Whether that's from a bean crop that's actually 49 and a corn crop that's 175, or a 46 bean crop and a 171 crop. We won't know until January on that one. In the livestock market, we've seen cattle just explode higher, over $10 higher in a matter of 6 days. Came into the week expecting that, all right, Labor Day is past, maybe demand's down, and we were looking at 155 cattle. People were expecting steady cattle cash trade this week. Well, that exploded $4 or $5 higher to the 159 and 160 levels. And today, when we exit the cattle market, you're looking at October, taking all that basis out of there and just trading in tune with the cash markets now. Some are trying to blame this this increase in prices that there's going to be a ceasefire over in Ukraine. Thus, we're going to stop the food bans and we'll start getting some pork and beef over to Russia. But remember that ceasefire, that doesn't happen overnight. So I did dismiss that somewhat. I think we're just looking at some stronger cash to fill in some holes. Sounds like Packers are bought out 2 to 3 weeks, so they just had to get some immediate needs taken care of. Over in the equities, today was a big day out there with the unemployment situation. Non-farm payrolls came in at 142,000. That was less than the 230 that was expected. Your participation rate is down to about 62.8, meaning that 64,000 have left the workforce. So that kind of throws out, you don't even need to look at the unemployment rate. Those two numbers are not what was expected. They're a little softer numbers. So when you have softer numbers, bad news means higher prices in the equity market. And that's just the way it has been. You'll also see that with these numbers, the Fed won't be in any hurry to raise rates, and that'll keep this market chugging along as well. So now, back to the corn and bean market. I just want to throw out a couple charts to kind of let you know what this risk premium has done. So first of all, taking a look at the beans. We'll see, I've never done this before, so bean chart here. All right, this is our bean chart from today. And as you can see down here, we had an outside day up. Didn't take out the daily trend line, but we had an outside day up, which will be bullish for the start of next week. That is confirmed on the weekly with a doji pattern down here on a weekly November bean chart. So look for some higher prices on beans next week. Now that'll be negated if we take the frost out of the forecast. In the corn, a similar chart in that on your daily chart, you're looking at an outside day up as well, but did not break the trend line, the daily trend line down. This, though, was not confirmed on the weekly charts, so you still have some more work to do in the corn market. I would expect a little bit better bounce out of the beans than out of the corn next week if we continue to see these frost scares. Even though that ratio is way out of whack, it looks like the beans have the technical support that it needs to have a little bit of recovery. So that is where we are for the first week of September. End of broadcast.